When it comes to building long-term wealth through US markets, dividend growth ETFs have become one of the most powerful strategies. But here's the catch. Not every ETF that pays dividends is worth your money. Some offer extremely high yields but fail to deliver consistent capital appreciation, while others grow steadily but rarely pay anything back to investors. So, we decided to cut through the noise and shortlist 5 of the most reliable US dividend growth ETFs for 2025. And we followed a strict framework while doing so. Minimum $1 billion in AUM, ensuring liquidity, stability, and investor trust. 10-year CAGR above 10%. We wanted funds that have proven themselves over a full market cycle, delivering solid capital appreciation. Dividend yield of at least 2% and above. We avoided funds with flashy but unsustainable payouts and focused on those that offer steady, growing income alongside long-term growth. The best part, every ETF on this list has a track record of wealth creation backed by quality companies. And here is where it gets even more interesting. If you watch the video till the end, you'll discover one special ETF that has delivered a 12% CAGR over the past 10 years and comes with a dividend yield of 3.73%. That combination of growth and income is rare. It could be a game changer for investors looking to balance capital appreciation with steady dividends. So let's dive into the 5 ETFs we have shortlisted and break down each one of them. ETF 1, iShares Core Dividend Growth ETF, DGRO. Now, this particular ETF is designed for investors who wanted a perfect balance between steady dividend growth and long-term capital appreciation. $33.86 billion in AUM, DGRO is one of the most trusted names in the dividend growth space. For the past 10 years, this ETF has delivered an impressive 13.09% CAGR, making it one of the best performing ETFs in this list. While its dividend yield is of 2.11% is relatively modest, the fund focuses on companies that consistently increase their dividends year after year, ensuring sustainable income growth over the long run. DGRO tracks the Morningstar US Dividend Growth Index, which screens companies based on 5 key factors. A minimum 5-year history of consistent dividend growth, a payout ratio below 75% ensuring dividends are sustainable, exclusion of the top 10% highest yielders to avoid potential yield traps, strong earnings prospects to support future growth, focus on large and mid-cap companies with strong fundamentals. DGRO holds around 400 stocks, with its top holdings which particularly include Microsoft 3.7%, Apple 3.5%, Johnson & Johnson 2.5%, JP Morgan Chase 2.3%, P&G 2.1%. From a sector perspective, the fund is well diversified across technology, healthcare, financials, consumer staples, and industrials, reducing exposure to any particular segment. With an expense ratio of just 0.08%, DGRO offers efficient and cost-effective exposure to quality US dividend growers. This ETF is ideal for investors who prioritize dividend growth consistency over raw yield, making it a solid first step in this list before we move to slightly higher yielding ETFs. Now coming to ETF 2, Vanguard Value ETF, VTV. Next on our list is this particular ETF, which is a fund designed to give investors exposure to high quality US large cap value stock. Managing an impressive $145 billion in assets, VTV is one of the largest and most established value focused ETFs in the market. Over the past 10 years, VTV has delivered a CAGR of 11.56%, providing steady capital appreciation while maintaining a dividend yield of 2.12%. It's an excellent choice for investors who want exposure to mature cash-generating companies without compromising on long-term growth. VTV tracks the CRSP US Large Cap Value Index, which focuses on companies trading below their intrinsic value but with solid financial performance. The fund holds somewhere about 350 stocks, making it well diversified while maintaining significant exposure to industry leaders. The top holdings in this particular ETF are Berkshire Hathaway of about 3.5%, JP Morgan Chase 2.9%, Johnson & Johnson 2.3%, ExxonMobil 2.2%, P&G 2.1%. Now, again from a perspective, VTV leans heavily into all kinds of sectors including financials, healthcare, industrials, energy, consumer, which are traditionally more resilient during market slowdowns. This makes the ETF a reliable defensive option while still offering solid growth potential. Now, with an expense ratio of just 0.04%, VTV is among the lowest cost ways to invest in a diversified basket of high-quality value US stocks. It appeals to long-term investors looking for stability, predictable dividends, and steady wealth compounding. VTV acts as a natural bridge between high-dividend ETFs like VYM and more growth-oriented ETFs that we'll discuss next, helping create a balanced foundation for dividend growth portfolio. Now let's talk about ETF 3, Vanguard High Dividend Yield ETF. Now VYM is one of the most reliable names in the dividend ETF space. Managing over $64.8 billion in assets, this ETF focuses on high-quality US companies that consistently deliver above-average dividends while maintaining solid long-term growth. Over the last 10 years, VYM has achieved an impressive 11.55% CAGR, striking the perfect balance between capital appreciation and steady income generation. Its dividend yield of 2.53% makes it an attractive choice for investors seeking sustainable payouts without exposing themselves to risky high-yield strategies. VYM tracks the FTSE High Dividend Yield Index, which focuses on companies with very strong fundamentals and proven histories of rewarding shareholders. This ETF holds about 580 US large-cap stocks, with the top holdings including Broadcom of 6.8%, JP Morgan Chase 4.1%, ExxonMobil 2.4%, Walmart 2.1%, Johnson & Johnson 2%. The portfolio here again is diversified across sectors like financials, technology, healthcare, and the list goes on. All the three ETFs that we have discussed so far kind of lie in the similar category, and they have the potential to be resilient across market cycles. Now for VYM, the expense ratio is just 0.06%, which is also one of the most cost-efficient options to enter the US market and to get good dividend yields. For investors who want a foundational ETF that combines reliable income with consistent wealth creation, VYM is also another excellent starting point. It sets the stage for more aggressive growth-focused ETFs that we'll explore next. Now coming to our ETF 4, which is a little different, iShares MSCI Taiwan ETF. Now this is a unique addition to this list because it offers exposure to one of the fastest growing Asian markets while maintaining a solid dividend income. With $6.17 billion in assets under management, AWT provides a gateway to Taiwan's world's leading semiconductor and technology sector, making it a strategic play for growth-oriented dividend investors. Over the last 10 years, EWT has delivered an impressive 13.63% CAGR, the highest among all the ETFs in this shortlist. Its dividend yield of 2.75% makes it an attractive option for investors seeking a mix of steady income and significant long-term appreciation. EWT tracks the MSCI Taiwan 25 by 50 index, which focuses on Taiwan's largest and most influential companies. It holds around 90 stocks, and the fund is heavily concentrated in the technology sector due to Taiwan's dominance in global chip manufacturing. The top holdings include Taiwan Semiconductor Manufacturing Company, which is popularly known as TSMC, for about 23%, MediaTek 3.9%, On High Precision, which is Foxconn, about 3.5%, Delta Electronics 2.6%, Cathay Financial Holdings about 2.4%. Technology now accounts for about 60% for this fund, with financials, industrials, and materials making up for the rest. This sectoral tilt positions EWT as a growth-focused ETF while still providing consistent dividends from profitable export-driven companies. While the expense ratio is slightly higher at 0.59%, but this ETF offers rare international diversification with exposure to some of the most innovative companies in the world, and that is what makes it worth it. For investors looking to combine dividend income with Asia's technology-driven growth, EWT stands out as a strong candidate. Now, our last ETF, which is going to be SCHD, which is the Schwab US Dividend Equity ETF, one of the most popular and widely respected dividend focused in the US market. With an impressive $72 billion in AUM, this ETF has earned a reputation for delivering strong income and consistent long-term growth. Over the last 10 years, SCHD has delivered a 12% CAGR, making it one of the best performing dividend ETFs available today. What sets SCHD apart is its dividend yield of 3.73%, the highest in the shortlist, while still maintaining a robust record of capital appreciation. SCHD tracks the Dow Jones US Dividend 100 Index, which focuses on high-quality companies with at least 10 consecutive years of dividend payments. The index applies additional filters like return on equity, free cash flow, and dividend growth rate to ensure the portfolio is concentrated in financially strong shareholder-friendly businesses. The ETF holds 100 carefully selected stocks, and the top holdings include Broadcom for about 4.5%, Home Depot 4.3%, Cisco Systems 4%, PepsiCo 3.8%, Coca-Cola 3.6%. Now, the sector exposure again here is well balanced, with allocations to technology, industrial, consumers and financials, and also healthcare, creating a diversified foundation for long-term investors. With an expense ratio of just 0.06%, this particular ETF offers low-cost access just like the other first three ETFs that we talked about. For investors who are again looking for a good entry point and they're looking to balance where they also want a high dividend yield rate along with good capital appreciation, this particular ETF is a very good entry point. And there you have it. 5 of the most reliable US dividend growth ETFs that balance consistent income, strong capital appreciation, long-term stability, from DGRO's focus on steady dividend growth to VTV and VYM's balanced approach to value and yield, EWT's exposure to Taiwan's booming tech sector, and finally SCHD, the star of this list with its 3.73% dividend yield and with its 12% plus 10-year CAGR. The key takeaway here is simple. The goal isn't to chase the highest dividend yield or make quick gains, but to focus on quality, consistency, and growth over time. By combining these ETFs strategically, investors can create a resilient portfolio that not only provides steady income but also builds long-term wealth. If you found this analysis helpful and want more insights into global investing strategies and ETF research, then make sure you subscribe to this channel and hit the bell icon so you never miss an update. Your investing journey is all about making informed choices, and that starts with knowing where the real opportunities lie. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.